Good afternoon once again, everybody, and welcome to today's economic and financial update webinar entitled Where Are We in the Cycle? I'm really glad we've got a really strong number of attendees and registered parties for this webinar. There's no doubt that the current markets are most likely playing into the minds of many of our investors and clients, and we're hopefully going to provide you with a little bit of an insight as to where we believe the markets are in the cycle, what might be the future, and then of course some potential investment opportunities that derive from the particular time in the market that we're in. A few things to get us started as usual, just to let you know that this is not personal financial information. All the information we are talking about today should be considered general in nature. If you do have any particular interest in a fund that we are talking about today, please do consult either a financial advisor or read the product disclosure statement available from us. For those of you who have attended our webinars before, this is probably old news, but I will just tell you a couple of things about on the housekeeping side of things. Number one, there will be a recording of the session and slides that are sent to all registered attendees. Number two, there is an opportunity for you to be interactive and to ask questions of our host today. And you can do that by typing it into the little questions section you can see on the screen there in the widget, the GoToWebinar widget. We'll most likely try to leave the questions till the end and trying to get to as many of those as we can. So today's webinar, it's a quarterly webinar that we've been running for a couple of years now, and is hosted by our esteemed Chief Economist, David Bassanese. David is probably familiar to most of you. He writes a weekly post in our BetaShares Insights newsletter. Formerly was a writer at the Australian Financial Review for about a decade, but has also been in Treasury as an economist, as well as at Macquarie Bank and the OECD. He's also written the authoritative Australian ETF guide. So today, what Dave will be taking us through, and hopefully, as I said, will be useful to many of you, given the current volatility we're seeing in the market, is a little bit of an outlook on international markets, talk about Australian markets, and then, of course, focusing on some investment ideas that we are seeing to be potentially interesting in the current market environment, and also taken up by a number of our investors at the moment. Two other parts of housekeeping. There are handouts in your widget there you will see. There's 5 handouts for the individual products that David will be talking about at the tail end of the presentation. I'll just start with a bit of interactivity. Just 2 questions that David's picked to try and get a sense for the mood in the room, so to speak. So on your screen there, you will hopefully see something that says, do you think the ASX 200 will be lower or higher at year end, so that is 2018 year end, than it is now? If you please say either higher, lower, or the market will stay the same, and we will report back on what the attendees are thinking in that respect. So I'll just close that and share the results of that. So the results of that is that, well, it's reasonably split, but certainly there's a higher majority. So the majority of 50% of people think that, exactly 50%, funnily enough, think that the ASX will in fact be higher than it is now at the end of the year. But a whole 30% are saying it's, well, basically the remaining 50% is either it's going to remain the same, or in fact will in fact be lower. Now to the other topic that David has chosen for your information is, do you think Donald Trump has been a positive or negative for equity markets? And we spoke about a bit of this internally. Definitely, there's 2 ways you could view this, and I would love to hear what people are saying. So I'll just let those come through, and I will close that one down and let you see the results of that particular one. And the results of that is that, again, it's reasonably split, but the most people think it's been positive, but a pretty good number think it's either neutral or negative. So look, these are very pertinent points right now, just given the state of of the market. And now I'll hand over to David to take you through his view and hopefully answer your questions about the current economic environment. Over to you, David.
Thanks very much, Alan, and thank you all for joining us today. And obviously, pretty interesting times in markets. As former RBA Governor Glenn Steve, I think he didn't come up with the quote, but he often used to use it. May we live in interesting times, and we're certainly living through some interesting times at the moment. So let me go through as Alan mentioned, I've basically broken down the webinar today into three elements. First, the international outlook, Australian outlook, and then some investment ideas. So if we just go to the first slide. So basically, where are we in the cycle? That's how I headline this webinar. So I guess I should directly answer that question. Look, this is a chart of the MSCI World Equity Index. It just shows you global equities, going back over 40, 50 years. The shaded areas are bear markets. So where on a month-end basis, markets have fallen by more than 20%. And as you can see, we've more or less been enjoying a relatively long equity expansion, of which Australia has participated more or less since the GFC in early 2009. We've had a few pullbacks in that period, most notably early 2016, a little bit early this year, and obviously now we seem to be having another correction where the S&P market, at least on a daily basis, is down about 10% from its highs of last month. So, markets do have these corrections, and every decade or so we do get a large, large bear market of more than a 20% or so decline. So, look, we are at a mature stage of the cycle. History suggests we will eventually get, a relatively large downturn at some point. But we also do get quite regularly so-called corrections, of declines of at least certainly 5% is very common. And then around 10%, 10 to 15% is not unheard of also during periods of a longer bull market. Where are we now? So we are at a mature stage, but I think there's a bit more room for this market to run. My base case is that this isn't the big one. This isn't the start of a bear market. I think the peak in the markets could still be at least a year or so away. Beyond, people talk about what might happen in 2025 and all that sort of stuff. At the end of the day, we can just the foreseeable future is the next 1 to 2 years, and that's my investment time frame in terms of, allocating from a tactical point of view. And on that case, I still see things holding together. But, the markets, as explained in this slide, the markets are facing two conflicting forces. Firstly, rising interest rates, particularly in the United States, which is tending to put downward pressure on valuations, equity market valuations. But offsetting that is ongoing growth in corporate earnings. And so, how these two play out will basically dictate how markets go. And as I've said, it's good start is that we've got reasonable equity valuations. The US economy retains good momentum. Some slowing in growth is likely next year after the tax cut effect tapers off. But the economy has been growing at a pretty solid 3 to 4%. Potential growth is closer to 2 to 2.5%. So some slowing is healthy and likely, but doesn't necessarily mean you get a recession or a bear market. And the critical issue is inflation. And provided inflation remains under control, the Fed will be gradual in tightening, and markets can muddle through. So we're not looking at big gains in equity markets, but certainly muted overall gains. But certainly conditions not yet warranting like a big nasty bear market. So just go through some of those points. Firstly, so here's a longer run chart of the S&P 500 index. And again, I focus on the US market because that's the one that still really drives global markets. When US sneezes, we all catch a cold, as the saying goes. So look, at the moment, you can see that dot line is where the PE valuation for the market was and bond yields as of yesterday. The PE ratio is about 15.2. It's come down from a high 16.8 at end of September. And with a bond yield of even then just over 3%, that's reasonable value, from a very broad brush, long run point of view. In fact, the line of best fit through all those monthly observations would have fair value at about 16.3. So the PE ratio was actually a little bit below, fair value on that basis. So, that we're not, people say the markets are overvalued. I've made this point in the past. PE valuations are above average, above their 10-year average. But, it's being pushed there because interest rates are still quite low relative to historical, periods. And certainly by the comparisons of, say, the late 1980s and the dot-com bubble of the late 1990s, markets aren't the US market isn't overvalued given where interest rates are. As I said, what will then happen is what will happen to interest rates, because as interest rates rise, as you can see, that will then tend to push down valuations for the equity market. On the other side of things, the equity earnings market outlook is still quite solid, as I said. So that's just those lines there are basically consensus estimates for so equity analysts looking at all the individual companies, and groups like Bloomberg and Reuters aggregate that up into earnings estimates for the overall market. And so you've got estimated earnings for companies in the S&P 500 for various calendar years. And then that line that links them all up is what's called forward earnings. So it's a measure of earnings for the current financial year and the next financial year. Bottom line of all that is that earnings are expected to be higher next year than they are this year, and then higher again still in 2020. And those expectations have been holding up so far. And based on those expectations, you're looking at something like 12% growth in forward earnings between now and the end of next year for the S&P 500. So that is a good tailwind for the market in the face of the potential, weakness in PE valuations if interest rates rise. Just on that, so then we get back to the other interesting issue is obviously interest rates. And again, from a very broad brush point of view, this is the US 10-year bond yield. Again, going back over that period since the mid-1960s, as you can see, by a historical perspective, they're still quite low, but nonetheless are rising. So they did bottom at 1.5% back in mid-2016. They've recently broken up above 3% again, on their way to what I think will and they touched 3.25% during the bond market sell-off in the past couple of months. And basically that was the catalyst for the initial sell-off in equity markets over the past few weeks, is that the US economy remains strong. The Fed of basically the US Federal Reserve, the US central bank, has reiterated that it expects to continue raising interest rates. Short-term interest rates, which as you can see is that black line there. And as that short-term rate gets pushed up, it tends to push up longer-term rates as well. So we've had a bit of an adjustment. So where that bond yields go will obviously depend on where the Fed goes. And this is where the next chart is pretty important. And this, ladies and gentlemen, is what I will say is actually the single most important chart in global financial markets today. This is the state of the US labour market. The green line is the unemployment rate in the US, which as you can see on the right axis there is just under 4%, about 3.8%. And on the left axis, you've got year-on-year growth in wages, a couple of measures from the monthly payrolls report. As you can see, as the unemployment rate has drifted down over the past few years, wages growth has slowly been grinding higher. And over the past year, it's accelerated somewhat more, from around about 2.5% to now almost 3%. Historically, central banks don't like to see that much above 3.5%, 4%. So when and if we do get to that level, that's when the Fed will get aggressive on interest rates and basically bring the whole party to a close and engineer a slowdown in the US economy, which would cripple corporate earnings, and that's when we'd probably see a classic bear market. But it is contingent on wages accelerating a lot more than we're seeing at the moment. Now, and again, some people out there who are bearish, they say, bond yields are going a lot higher, the Fed is going to be a lot more aggressive, counting on wages growth accelerating in a big way. But my base case is that that's not going to happen. I still see wages growth moving higher, but still in a pretty slow and orderly pace. Such that by the end of next year, I see those those lines basically being closer to 3.5%. You know, they will break 3%, and in fact that may happen on Friday. There's a payrolls employment number in the US on Friday, which concludes those average hourly earnings numbers. And consensus is that the annual rate will actually lift from about 2.8 to just over 3% in those numbers. So the markets may, you know, react possibly negatively to that, what I call sticker shock, because it's gone from a 2 handle to a 3 handle. But again, provided it's slowly going higher, then that's still a good outlook for the Fed. And why is that my view? Because what we're seeing around the world is that if you look at the next chart, so this is looking across a number of countries, developed countries. Labour markets are by the standards of different countries in Europe and Japan are quite tight in many countries. We've had good employment growth over the last few years. Unemployment rates have been falling, and as of yet, not a lot of wage reaction. So, you know, for good or bad, you know, the labour markets are a lot more competitive. Workers have a lot less bargaining power than they've tended to enjoy in previous decades. And if that remains the case, I think wages growth is going to remain pretty well contained. So just some forecasts. Again, these are central case forecasts. So, you know, no one can predict with certainty where markets are going to be next month or even next year. But what we can do is give reasonable scenarios based on valuations, based on a reasonable, you know, outlook for the economy. So I said underpinning all of this is this expectation that US wage inflation in particular won't accelerate in a big way over the next, 6 months to 1 year. Now, if I'm wrong on that and the wages do accelerate a lot more, obviously that'll be a more bearish case scenario. So these are based on that underlying projection. But with that, I won't go through it. In the interest of time, I won't go through in a lot of detail, but basically looking at US 10-year bond yields rising, the Fed funds, are still rising, hitting around a range of 2.75% to 3%. That implies another Fed move in December, and then 2 interest rate increases in the first half of next year, but then the Fed actually going on hold. So, that's a little bit less than what the Fed are actually saying at the moment, but I think they'll raise rates twice in the first half of next year and then announce a pause. That's still consistent with bond yields rising, which will actually, and if you look at it, fair value, even with the 10-year bond yields at 3.5, is for the PE ratio in the US to be at 15.5. So it's actually a little bit higher than what we've got at the moment. So you could say the markets have sold off a little bit more than is warranted. Meanwhile, so basically PE ratios on those numbers is a fairly neutral factor for the markets, but the positive will be earnings growth still coming through. And again, provided the economy keeps chugging along, I think those earnings expectations will hold up. So what about some other risks out there? I've really just focused on US wage inflation. The other ones, obviously the trade wars. So Donald Trump has, obviously the big focus at the moment is the tensions between the US and China. A couple of points. Firstly, he did have a battle with Europe, Canada and Mexico in recent months, and basically has shown a capacity to resolve his differences there. They did actually come to a trade deal, which at the end of the day, the changes to the existing trade agreements he had were, in my opinion, relatively moderate, or incremental or tokenistic might be a harsher view. And I suspect something similar is going to eventually pan out with China. Where they would, and in fact, overnight the markets are up because he did talk about the potential for striking a deal with China over the next few months. But he's basically, the way in which he negotiates, obviously, is he offers the carrot of a deal, but also the stick of high tariffs. So he said he's basically threatening China with a lot more tariffs. But in a way, China is sort of calling his bluff because China isn't sort of bending to the threats of tariffs and is holding off. So the ball is a little bit back in Donald Trump's court in terms of how this will all resolve itself. But just for perspective, I've just got their orders of magnitudes. If the Chinese export to US about $500 billion worth of goods in a year, so about $500 billion. So in the worst case scenario of a 25% tariff across all Chinese imports, it works out to be something like 0.6% of US GDP. So, I mean, again, the media like to talk they quote big numbers like billions. What's often forgotten is that the US economy itself is a $19,000 billion economy. So, you know, even a 25% tariff on $500 billion, that works out to be at $127 billion income shock. That's about 0.6% of the economy. So it's not insignificant, but it's something I think even in a worst case scenario, the economy could weather without necessarily toppling over into recession. And certainly if it remains contained, I mean, again, we're not talking global trade wars here. We're talking largely US, China, albeit the two most important countries in the world. And it's really one country imposing tariffs on the other, and that China is not, at this stage, retaliating in a big way versus the US. Midterm elections, November 6th, the US hold their vote for the Congress and the Senate. Just some survey there from a group 538. They are like one of the leading, I guess, analysts in the US on these matters, and they're basically looking at the probabilities are such that the Democrats are likely to regain control of the lower house, the House of Reps, but not get enough to get control of the Senate. So as you may know, the Republicans now control both the lower and upper houses of the US, which makes it relatively easy for Donald Trump to get his tax cuts through, for example. Still didn't manage to get a lot of his healthcare package through, but it's easier for the president to pass stuff when the Republicans control both houses. But at this stage, it looks like the Democrats will win back the control of the lower house, which basically suggests, look, at the end of the day, it's going to be a bit of a negative for markets, and that the bottom line of all that in terms of impact on markets will be it's less likely that we'll get more fiscal stimulus, in particular an infrastructure package. If the Republicans did retain control of the House, we might have seen a big infrastructure package coming through. But having said that, the US fiscal deficit is already enormous, and so they don't really have a lot of capacity to spend a lot more, but that probably wouldn't have stopped Donald Trump anyway. But what you're likely to see is gridlock. I think at the end of the day, it's going to be fairly neutral for markets. I think it's, we'll basically, resign ourselves to more gridlock in Washington, which has really been a feature of US politics for a long time, and markets will proceed accordingly. The other risks, just to mention, but again, these are really sideshows to my thinking in terms of the big picture. Again, the big picture is that US wage story and what the Fed does with interest rates. Italy, it's attracting headlines. Again, in the interest of time, I won't go into a lot, but they want to run a budget deficit bigger than what the EU would allow them under the sort of budgetary arrangements in Europe. They're now renegotiating that. But at the end of the day, from a global perspective, all we really care about is whether Italy, one way or the other, would eventually leave the EU. And that's, no one's really talking about that. So this is a squabble that Europe will need to deal with. Potential adds to the weakness of the euro versus a solid US dollar, which ironically can be good for European export countries such as Germany and France. So a weak euro is actually a healthy outcome for European equities. The other one is China. Again, talk about a China slowdown, has been around for years. At the end of the day, the policymakers there still retain enough tools to manage the economy. If need be, they can throw the switch to more fiscal stimulus. The run-up in corporate in debt amongst state-owned enterprises is obviously worrying from a longer-term perspective, but there's no reason to think the chickens will come home to roost anytime soon. So China will basically keep muddling through, and it's not really, again, I think these are like sideshows to the main game. In terms of Australia, just a couple of points to note. I mean, given we live here, I'll spend a little bit more time on the economy. So I get one of the more important, developments or news items over the past month or so has been the unemployment rate did tick down to 5%. As you can see from this chart, it's really been trending down over the past few years. It stabilised there for a while, but earlier last year, but it's now started to trend back down again. So the employment market has been tightening. and actually a lot tighter than what the RBA expected. So the last RBA forecast, Reserve Bank forecast, for the unemployment rate not to hit 5% until the second half of 2020. So, look, it may bounce back a little bit in the next few months, but bottom line is it's progressing pretty well and probably tightening more quickly than the RBA expected. I don't think that's going to change their tune on interest rates. I'll talk about that in a minute. But again, the other feature of the economy is, what we're seeing is pretty broad-based growth in employment that's been underpinning that decline in unemployment. So infrastructure and home building are still at high levels across the country. So construction employment, I thought this is an interesting stat out of a recent speech from Reserve Bank Deputy Governor Guy Debelle. Construction employment is at 10% of total employment, which is the highest level since the 1920s. So, we're seeing a lot of busy vests, a lot of trades, a lot of tradies, around the place, and that's why construction employment is really at quite strong levels. Also, the ongoing rollout of the National Disability Insurance Scheme, you're seeing good growth in healthcare, jobs. Manufacturing is also doing well. So food and beverage exports, we're actually, starting to make things again in Australia. So the Chinese in particular are demanding a lot of different food and beverage products, and you're seeing that through milk, for example, the powdered milk and things like that. And professional services and ongoing investment in computer systems, leading to good growth in IT and professional services. But in terms of the RBA outlook, we're still waiting for inflation to pick up, and waiting in particular for wages growth to pick up. So unlike in the US, where wages growth is grinding higher, albeit at still a relatively slow pace, wages growth here is still quite muted, running at just around about a 2% pace. Look, the outlook at the moment is that's unlikely to change anytime soon. So even though we've hit 5%, full employment in Australia is probably closer these days to 4 to 4.5%. And also, just a bit of news, we did get the CPI out today, the Consumer Price Index for the the September quarter, and it had annual inflation, annual underlying inflation, which is what everyone sort of looks at, stripping out the volatile items, still running at about just under 2%, so 1.75%. So not yet at the 2 to 3% band that the RBA is talking. So bottom line of all that is, until such time as we get a more decent pickup in wages growth, which requires the labour market to tighten up even more, and/or inflation lifts, the RBA is still essentially on hold. So what about house prices? Again, just a few quick comments on house prices. Obviously, another big feature of the economy at the moment is declining house prices, particularly in Sydney. So the median house price in Sydney, according to CoreLogic, is off around about 5% from its peak levels of late last year, around August of last year. I just point that again, the dashed line there is a measure of mortgage affordability. So that's how much it costs a household an average income to service a mortgage to buy a medium-priced Sydney home. So what you can see there is the market peaked out at around about those affordability constraints that we've seen in previous cycles. So the cycle we're experiencing is nothing out of the ordinary in terms of what we've experienced in the past. So to the same extent, I think the likely decline in prices won't be out of the ordinary compared to what we've seen in the past. So just going to the next slide there, that's the peak to trough declines in Sydney property over the last decade or so. So the last great Sydney house boom was from 95 to about 03-04. And then we had a correction, almost a 10% correction. This is based on ABS numbers now. But then in the GFC, we had a correction of around about 7% or so, and more recently some house price declines as well. So nominal house price declines in a low inflation environment are not unusual. I mean, certainly over the past decade or so. And again, so what we're seeing is not is something we haven't, we've seen this before. Some people, I think house prices in Sydney will decline probably around 10 to 15% when all is said and done over the next couple of years. But most people will, that have a mortgage will retain their house. I mean, on paper, it will be worth less than it was, a couple of years ago, essentially. But there's no real catalyst to suggest that mortgage default rates need to skyrocket. Banks need to be in serious trouble just because we get an adjustment in property prices. So again, a lot of negative headlines about this, but at the end of the day, I mean, we're going to weather this in the same way we've weathered it in the past. Some other elements to interesting points. Obviously, the Australian dollar has been trending down, and it's now almost just flirting with that 70-cent level. So I've been negative on the Aussie if you've been listening to these webinars for a while, for some time, and it's basically following the path expected on the back of the RBA on hold and the US Federal Reserve raising interest rates. So the interest rate differential has gone more and more in the US favour. So international investors tend to not to want to hold the Aussie dollar in that situation. It probably will eventually break 70 cents sometime either this year or next year, and the trend, is probably still down somewhat. But, when the RBA eventually does come to raise rates, it should, and the Fed goes on hold, you could see the Aussie dollar, rebound somewhat. So my year-end target for 2019 is actually the Aussie to be around 70 cents, not a lot lower than what it is at the moment. Just some comments on the share market. So here's the share market over the past few years, and as you can see, we've gone up in fits and starts, and just when we start getting optimistic, we have quite a notable pullback. Again, that pullback is in line with what we've seen globally, but it just shows you how fast the corrections can be in the share market. So we've had almost a 10% pullback within the space of a few weeks. From a longer run perspective, as I said, this is the same chart as what I showed you for the global MSCI. This is the Australian market. So again, we've more or less been enjoying a long bull market period as well. We haven't gone up as fast as global markets, but as you can also see from that chart, we do tend to be correlated with the US market. So usually when the US share market has a big correction or a big bear market, we usually follow. The one exception to that was during the dot-com bubble, when the US market did fall hard because of the big decline in tech stocks, which were really overvalued at that time. Because of our low exposure to technology, we didn't fall by as much. But look, going forward, if the US market does have a bear market, we're probably going to follow, given the tight correlation. Valuation-wise, again, not too dissimilar with the United States situation. So here's a very long-run perspective on our market. So the PE ratio, the price-to-earnings ratio for the ASX 200 was at 16 last month, and now it's dropped to 14.5. Not bad valuation given where bond yields are. So, but we're saying, and with our bond yields, not likely to go up as much as in the US. In fact, although US bond yields have been rising the past year or so, ours essentially haven't been, because the Fed's RBA has been on hold. I mean, there's less downward pressure, even less downward pressure on our valuation. So that's a positive for our market. Less positive is the earnings outlook. So again, whereas the US market's looking at 12% growth in earnings between now and the end of next year, our market is looking at growth in earnings. It's plus 6%. But if you look closely at those lines, there has been some downgrades in the earnings outlook over recent months. And so the risk is that we do get further downgrades in our market. The trend in earnings revisions has been negative. So that puts a bit of a negative slant to the earnings outlook. Bottom line, I still think our market is going to, even though interest rates aren't rising, whereas they are in the US, our market's likely to, not outperform. Maybe, it keeps pace, but it's certainly going to be constrained from an earnings point of view. Just got some numbers there. Again, I'm running out of time. I've got to talk about my investment ideas, so I won't go through that in any detail, but under a reasonable scenario with interest rates, bond yields essentially rising somewhat on the back of US rates going high, but also I've penciled in a rate rise by the RBA in the second half of next year on the view that, we will eventually get some uptick in wages growth. But on that view, bond yields go a bit higher, still ending a little bit lower than what they are in the US. But valuation-wise, the market can still head up from where it is 14.5, and even with muted earnings growth, you're getting some growth in the equity market. So with that, I'll turn to some investment ideas in the current. To sum up, look, things still look okay, though we are at this mature stage of the cycle where inflation is a potential risk in the US, and the central bank there is certainly raising interest rates. And so, at some point you may get a flip where the interest rate, drag on the market outweighs the growth in earnings. So, it is a time for caution, some caution, I would say. And the first point then I would make is asset allocation is critical. I mean, what I've said today is still, I guess an optimistic outlook in the sense I don't think we can have a bear. If you're worried about equity market declines, you've got the first important point here is to get your asset allocation correct. I mean, I can't give you personal advice. You've obviously got to take that. The thing about, again, with exchange traded funds these days, the funds that we run, there's a lot more different types of exposures out there than just equities. So if you need income and you're worried about market volatility, worried about market downturn, you could consider some what we think are quite innovative income products. Our long-dated corporate bond, a hybrids fund that invests in hybrid securities, HBRD, and coupon, which is a floating rate bond. And now the bottom line of that chart is, you can see, certainly, look at what's happened most recently. The equity market here has been off 10%, yet these bond exposures have hardly moved. So valuations have held up pretty well. So that is where defence, pays. So in the long run, bonds aren't going to give you as great a return as equities, but certainly they give you a relatively stable income, and they certainly protect you on the downside when equity markets are selling off. And just to underline that point, here are some of the interest rate, or the prospective income return that these sort of funds are offering at the moment. So our AAA cash fund offering you a return of about 2% on an annualised basis. That pays monthly. Again, a lot, better than what you get from a 1-month bank term deposit. And then if you want a little bit more capital volatility, because you're basically not investing in AAA invests in bank deposits, coupon, credit, and hybrids, in floating rate bank bonds and long-dated corporate bonds, and in the case of hybrids, obviously hybrids. So they give you higher prospective income returns, but with somewhat high volatility relative to cash, but certainly nowhere near usually what you'd see in the equity market. So I just leave that with you instead of those income opportunities. The other one is a managed risk exposure. We have an ETF, WRLD, which gives you exposure to the overall MSCI index, the one that I showed you earlier in the webinar. Basically, it's an automated rules-based strategy that basically reduces exposure of that ETF, the equity market, as volatility picks up. And the underlying premise there is that when volatility picks up, as you can see in that chart, periods of high volatility tend to be bunched up. So when it starts, it usually persists for a while, and it's usually associated with weakness in the equity market. So it's on our website. In the interest of time, I won't go through it, but automated downside management strategy that reduces equity market risk in periods of high volatility. So that's a way to get equity exposure, but potentially reduce some of your downside risks should we get a big bear market situation. And I'll just flick through the. We'll go to the. So I've already mentioned that slide, so I'll just flick to the next slide. A few other ideas. Again, this is more in the way of news also, is that we recently launched an ETF called A200, and it's the lowest cost Australian equity ETF in the world. So the management fee on that fund is 7 basis points, so 0.07%. So again, if you have a longer term perspective and you want to put some money in a simple plain index fund that tracks the largest 200 companies in Australia by market cap, you can invest in that at a very, very low competitive fee. And you can we've just done some projections there. If you invest in something like that over 40 years, paying only 7% management fee versus, say, the average active management fee, and assuming you invest in an active manager who, at the end of the day, doesn't produce a better return, the difference over 40 years compounded is almost 80% difference. So that's the power of compounding. So just something to bear in mind. And then another couple of ideas there. Also, we do have a couple of funds that are give you more of a value tilt, and these funds basically, instead of being market cap weighted, so they don't invest in companies according to the prices or the value that the market itself is ascribing to these companies in terms of market capitalization. We weight companies these funds at least weight companies by their underlying financial metrics such as earnings, book value, and dividends. And the bottom line of that strategy is that it tends to avoid increasing the weight to companies that are rapidly increasing in price and potentially becoming overvalued in the way a market cap index would, and vice versa, not reducing the weight to companies that are falling in price and market capitalization in the way a market cap index would. And that sort of avoiding chasing price does tend to generate outperformance over time for those indices. But there are periods, longish periods where it may only track the market, and in some periods where it does underperform, but certainly over time it has tended to outperform because of that. And as you can see, if you look at that chart, we've had a very strong run over the last year or so in terms of growth stocks. So companies that are already highly valued, and they've tended to continue to outperform, even though on a price to earnings or price to book value, arguably they're getting expensive. So those funds have tended to outperform. But if we do get a more moderate earnings outlook, and we do get a rotation back into, say, more value stocks, then these are potential funds that could outperform in that environment. So that's QOZ and QUS, both available. Again, you can get more information on our website. I'll conclude with a couple of funds that we've recently launched, and these, again, like the equity markets have had a pullback this year. The Asian markets, in fact, on the back of China, have also had a pullback. But there are some, pretty interesting, good longer-term growth stories that you may have interest in tapping into, and this is an opportune time to potentially get these growth opportunities at a good valuation. So the first one is Asia. So we have an Asia ETF, and it's basically it's almost like a Nasdaq, an Asian equivalent of the Nasdaq. So in the way our Nasdaq ETF gives you exposure to Google, Amazon, Facebook, these sort of companies, this gives you exposure to some of the top internet or technology companies in Asia, particularly in China. And the spending outlook for e-commerce in Asia, I'm sure it wouldn't surprise you to know that it's strong. So you're looking, based on one research company, looking at 30% annualized growth in the 10 years from 2015 to 2025, 30% annualized growth in e-commerce spending across Southeast Asia. And so that fund does tap into some of those companies. And just to give you an example of some of those companies, the next slide. So Asia, in fact, is home to 4 of the largest global tech companies in the world. So you see Apple, Google, Microsoft, Facebook are there, but some ones you may have heard of or may not have. Alibaba. Alibaba is probably the largest online retailer in the world, or online shopping marketplace, even bigger than Amazon. Tencent is very big in social networking. Baidu is not on that list, but Baidu is another company in this ETF, which is China's #1 search engine. So it's like a Google. It's the China's equivalent to Google, essentially. Look, there's a lot more information on our website. If you're interested in that, there is a brochure that goes into some of the arguments for that fund, but I'm running out of time, so I won't spend a lot more on it. I just mentioned also the other one is Robot, so RBTZ, and this is a fund that taps into the top companies around the world with good exposure to robotics. So they're engaged in creating robotics or artificial intelligence type solutions for companies across a suite of sectors: manufacturing, defence, healthcare, transport. So use of robots is widening across a whole bunch of different industries. And looking at demand projections there for sales of robots of something like 30% annualized between 2016 and 2025, and for artificial intelligence, almost 60% annualized growth is being projected by in that area. And again, so that shouldn't be a surprise. The technology associated with AI and robotics is expanding, at breakneck pace. Labour forces are aging and population growth is slowing around the world, so businesses are investing more and more in robots and AI as to replace labour that is hard to find. So it's a really good growth story as well. But more information is available on our website. So with that, I will conclude. And again, some I've tried to give you what I think is the most reasonable outlook for markets. Of course, that markets are uncertain, and some of my central case assumptions may not pan out. So, asset allocation is critically important here. And if you do want more personal advice for your particular situation, certainly seek it out. And with that, I will conclude. Happy to take questions.
Great, thank you, David. So we do have time just for a few questions. There's obviously been a whole lot that have come through, so we won't be able to get through all of them. David will hope to respond in writing to those we don't get to. Also, just to let you know, if you enjoyed that and found that information useful, David writes, as I mentioned, on our regular Insight newsletter, which you can sign up for on our website, and of course also does a Monday morning wrap-up of the week that was and the week to come from an economics perspective, which is called Bassanese Bites. We're also, of course, on social media, Twitter, LinkedIn, and Facebook, and of course via the email. So there has been a number of questions. I'll just try and skip through some of them and see what you might be able to answer here. I suppose we've answered the midterm elections question, which was asked by quite a few people, so we can probably move on from that. Let's just see here. Just bear with me. Look, there's a question here from James about global equities going backwards and speaking in January. He's asking, if that's not a bear market, what is?
Well, a bear market is a 20%. Well, the technical definition of a bear market is a 20% decline from a previous peak. We're not there yet in terms of the MSCI, but you're right. I mean, the markets have. We had a pullback in January, then we had a recovery. The US market in particular regained, hit a new peak level, and now that's off 10% from its peak level. So the technical definition of a bear market, I mean, if you want to define it by another term, that's fine. I mean, if a bear market for you is a period of sideways, volatile movement for a couple of years, maybe that's what we could well see over the next year or so, and in which case, under that definition, it is a bear market.
Now, there's a question here about from Darren about our bear funds. Question is, do you feel now would be a good time to protect against a falling market by holding a bear? So the bear ETF or the BBUS fund and BBOZ funds, these are funds that aim to go up when the US or Australian share market goes down. Bear is essentially close to a 1-to-1 negative correlation. BBUS and BBOZ are magnified or geared versions of those. Any comments on those, Dave?
Look, they are there for that. They're there for two purposes. If you're a short-term trader and you have a short-term view that the markets are going to go down, then they are tools in which you can exploit that trading opportunity. So it's really designed for that, and also it is designed for longer-term investors that may be sitting on a bunch of shares that they've held for a long time. You are worried about the market. You don't want to sell down your shares and realise capital gains, and then have the trouble of having to then buy them back and deciding when to buy them back. So you can effectively reduce your net exposure to the equity market, essentially go to cash in that sense, not in a sense of your net exposure to the market by owning some of the bear funds. And so, look, my view is, as I said, my base case view is that markets are going to end next year higher than where they are now. my base case view is that we're not in a bear market and that market's going to head a lot lower than where they are now. So on that basis, I would say, you know, you wouldn't want to use bear. But I mean, if you are nervous and if you disagree with my view, then you have that opportunity. The only other point I would make is if you do hedge your position, and you do get it wrong and the markets rebound, on paper you've made money, from your shares, but you will realise a loss on your bear fund. So you take that on board. And also, when you do try to get too cute with these things, and I'm not saying don't do it, but it's one thing to get out of the market in time, then it's another thing to get back in the market as well. So there's two questions when you time markets, particularly over the short run, is when to get out and then when to get back in, and both can be challenging.
There's a question about our FE and FAIR products. I could probably answer that. So this is a question about how have our FE and FAIR products been performing. We haven't spoken about those today. Now those funds are our Sustainable Leaders ETF. So these are funds that specifically aim to invest in companies that are essentially aligned with ethical principles. So number one, they need to be doing a decent job on climate, and second of all, not be doing a whole lot of things which many people would consider to be negative. That would be tobacco, alcohol, a number of things. The answer to the question is that both funds have been performing quite well. The numbers have only been cut up until September so far, and obviously that's before the big drop we've had. But the FAIR fund has probably done about 10% a year since the inception of that fund. And it probably would have outperformed, well, it definitely would have outperformed the Australian market to that period due to its lack of investment in the big banks, which were hit by the Royal Commissions. Second of all, the FE fund, which is the global fund, has performed particularly well. It's probably done around 20 to 22% a year since inception, which has definitely been an outperformance of a broad market index like a MSCI World. That is, of course, because of the large tech exposure that has. Now, that will obviously be hit by the latest, but I would still suggest that it's most likely to be outperforming even post those. So that's the answer to that question. And probably just two more here. Look, I suppose you've answered, but just to repeat for the audience, do you think the US and China will reach an agreement on trade?
Look, yes, I do. I think it won't be an agreement that will substantially change their. I think I think China may well offer up some relatively tokenistic. I think basically China will not be forced to the negotiating table to do a far-reaching trade deal with the US under any circumstances. And so if Donald Trump jacks up tariffs, across the board, it's not going to force China to the table. And so they're calling his bluff in that regard. So the question is, will Donald Trump settle for something relatively tokenistic to de-escalate things? And at the end of the day, if your threat of tariffs isn't working, you'd be mad to just continue with that because he's already getting a lot of pushback from corporate America on it. So I think at the end of the day, and a little bit of a tell on that would be the deals he signed with Mexico and Canada, which, again, at the end of the day, did open up markets somewhat for the US, but, relatively incrementally. And the NAFTA agreement between all the countries is still largely in place. Now, when that will happen, it's unclear. They are meeting there's a G20 opportunity next month, or they may, this thing may drag out for a while longer. But the bottom line, I think, is that some, they will agree to shake hands. The other little tell there is look at North Korea, where at one point he was threatening to bomb them back into the Stone Age, and the next hand he's got his arms around them and they're best friends. So things can change.
Excellent. Look, the last question, David, which we haven't mentioned, and I guess it is a useful one, is Brexit. So Adriano has asked, Brexit is approaching and a no-deal scenario is likely to materialise. What do you think will be the impact of such an event on international and Australian markets?
I think the impact will be pretty much not a big impact, essentially. Like the UK economy, look, there's argument. It definitely won't affect the EU. This is more a problem for the UK than the EU, because at the end of the day, the UK is it's an important country, but it's a lot smaller than the overall EU. So that's why the EU have been able to drive a pretty hard bargain here. Even at the end of the day, that there's basically you fall to what's called most favoured nation status, where the trade barriers that the EU have with other countries, such as Canada, the United States, will apply to the UK. Now, it's still a lot more complicated in areas like the financial sector and whatnot. There's talk of, some jobs will be lost to London. They go to Frankfurt and Dublin. So there's possibly a painful transition period for the UK. But given its small part of the overall global economy, I don't think it's really going to affect the global economy. In that sense, the UK has shot themselves in the foot, but it won't have a big spillover effect. But the other point is, I actually still question whether there will have a big, even if you do have this no deal and yet we have this default position, that I think you'll probably find the UK, gets out of it pretty well. And I actually think in the long run, I've had this view that the UK is probably better off outside of the EU. I think the EU is becoming overly regulated. The demographics are not great. More and more, there's a whole, it's a different culture in terms of way to run an economy. Europe generally is a lot more corporatist, a lot more government directed, and the English are more, a bit like Australia and the US, more Anglo-Saxon orientated. We're a lot more free market orientated. So there has been that cultural tension or tension for a long time, and it's basically, finally ruptured.
Great. Well, look, thank you everyone for that and for your attendance. As mentioned, a copy of this particular webinar and the slides will be sent to everyone who registered for their attendance. We will try to get back to those people who have asked questions that we haven't had the time to answer. But with that, I'll sign off, and we'll look forward to being with you next time around. Thanks all for your attendance.
Thanks, everyone.